My name is Rick Brimacombe, and on behalf of the Minneapolis Club, Upsize Minnesota, and my group, Club E, welcome to our panel discussion on acquisitions. Acquisitions are a rapid growth strategy, and a strategic acquisition can be much quicker and less stressful than organic growth. In thinking about our panel, kind of two stories came to mind that I thought would be relevant to today. And those of you who know me know that I can weave a long story. So the very short version is when I was at Piper in investment banking, actually did an IPO for a company that was completely built on doing a roll-up strategy and rolling up a bunch of smaller businesses, and ultimately went public. And then about 3 years ago, one of my portfolio companies, a SaaS business who had been growing now over the last couple of years quite nicely, 25, 30% growth annually, but doing it organically, has decided that they wanted to make some acquisitions to try to grow even faster. And so I'm currently working with a portfolio company that's trying to layer acquisitions on top of 25 to 30% organic growth. So acquisitions can be a very valuable way to grow your businesses, and certainly in today's hot M&A market, a good way to try to continue to grow your company and potentially lever what's happening out in the marketplace. To help business owners better understand best practices in this area, Upsize Minnesota and Club E has assembled today's panel. We're going to introduce a panel of experts who can serve as your trusted advisors to navigate this process. Upsize Minnesota is a how-to magazine devoted to helping business owners build bigger and more profitable companies. Club E and my firm, Brimacombe Capital, inspire business owners like you to achieve more than you thought possible by providing strategic advice and financial support. In our efforts to provide actionable content, Upsize Minnesota and Club E offer you today's panel, and as such, I'd like to introduce you to our event sponsors. Boulay is an accounting and advisory firm. Deluxe Corporation is a financial services organization. Highland Bank is a family-owned community bank, and Winthrop and Weinstein is a general practice law firm. Thank you to our sponsors. I greatly appreciate your support, and these events wouldn't happen without your assistance, so thank you. And folks in the audience, these events truly wouldn't happen without their support. So the extent that you can utilize the experts on the panel, please do. So with that, let's get to our panelists. I'm going to provide you a real brief introduction, and then we'll give them all a chance to tell you about their backgrounds. To my immediate left is Dean Willer, attorney and shareholder at Winthrop and Weinstein, where he's chair of the corporate practice group, as well as a board member. To his left, David Graft is executive director of corporate development at Deluxe Corporation. Melissa Johnston, third, is senior vice president at Highland Bank. And Ryan Turbies is manager of the transaction services practices at Boulay. Welcome. So now that you've been introduced to our panelists, let's hear a little bit from them as to how they fit into our discussion. Panelists, why don't you take a minute or two to tell us a little bit about your bios and your background with the audience. Ryan.
So hopefully this works. Ryan Turbis with Boulay. Thanks for the introduction, and
yes,
happy to be here today. So I'm a manager in the transaction services department. That's probably 80% of my time. We're dealing with both buy and sell side quality of earnings, typically dealing with enterprise values of, let's say, $5 million to $30 million. We do go north of that quite frequently, but that's probably our sweet spot. I really enjoy helping clients with deals that have hair on them, per se. I think that's where we can stand out. And really, our niche is within the search fund industry. We do work with a couple private equity groups here in town, but really the search fund space or sponsorship is really our sweet spot. And also other things that I work on, I do some consulting and normal attest work, helping clients anywhere from maybe 0 to 75 million in revenue. So wide range of services, and happy to be here, and we'll get into some specifics later.
Great. Thanks, Ryan. Melissa?
Yes, so my name is Melissa Johnston, and
It's a little quiet. Lean into it a little bit.
There we go. I'm tall. I need taller chairs. And I've been in banking on the commercial side for 17 years, so my entire career. I started at a bank holding company when that company was in acquisition mode. And while I was on the acquisition team, we looked at acquiring 5 banks and bought 2. And so stayed at that bank for a while, and I've spent my last 8 years at Highland Bank on the front line, where, like Ryan, I get to work with clients and help them navigate opportunities and challenges and really be that trusted advisor for them. I've had success on the acquisition side, helping clients identify opportunities that are right for them and appropriately saying no when it just doesn't make sense. So the owner and CEO of our bank is here today, Rick Wall, if you want to give a little wave, and then our bank president, Troy Rosenbrook, is here as well. And I also just like to share personally, I grew up on a farm in southern Minnesota and moved to the Twin Cities for graduate school. I have twin boys that are 10 and a daughter that's 6. Thank you.
What kind of farm?
Hogs, 10,000 pigs.
And that's still in the family, right?
Still in the family, yep.
Yeah. Okay. All right, David.
Hi, I'm David Graff. I run corporate development at Deluxe and have done that for the last 20 years. Over 40 years or so, I've been involved in doing deals one way or another. I started out in public accounting with very acquisitive clients. Went from there to Ecolab over in St. Paul. I've worked at Caldwell Industries, a few blocks away from here, for a number of years in more of an operating capacity. I guess I've viewed deals from a lot of different angles. I mean, I've supported them as a service provider. I've been an operator. I've done turnarounds, negotiated the deals myself. I've used advisors. We've done deals at Deluxe over the last 20 years with the object of changing the face of a 100-year-old company radically because we need to, and we need to keep doing that. And so acquisitions have been a very, very important strategic tool to help us get there. We've done between 50 and 75 deals in the time that I've been there, ranging from really small to roughly $800 million or so on the upper end. We're $2 billion in revenue today. A lot of people think of us as the check company still, and we still do that, and we still have a very important position in that marketplace. But it's now more like 40% of our revenues, not 100%. And so where did the rest of that come from? A lot of it has come from making acquisitions in strategically selected spaces, in areas we felt that we could play really strongly in and grow from. So we'll talk a little bit more about that, I'm sure, as we get into other questions later, but that's what we've been doing.
Great, thank you, David. Dean.
My name is Dean Willer. I'm the chairman of the firm's M&A department. I'm a corporate shareholder, been there for 15 years. Rick called me up and said he called some investment bankers and some financial advisors and dug really deep and got stuck having to put a law firm on the panel. Asked me if I'd do it. I said sure, and apologize if it's disappointing if you wanted to hear an actual advisor. But my unique specialty in our firm is that we have a lot of clients that have engaged in a lot of roll-up activities. I've been representing them for about 15 years, and I have some clients that have gone through 9, 10, 12 acquisitions in the strategic environment. We also do a lot of work with private equity funds who obviously are very acquisitive in their own nature. We also work with a lot of private equity funds, portfolio companies who often will engage in roll-up activity on their own. And as you start to see it, you realize it is a very attractive way to grow very quickly if it's done well. So that's why I'm here today.
Great, thank you. Well, let's see, we got one of two choices, Ryan or Dean, whoever would like to take this and run with this. So with that introduction for everybody's background, why don't we hear a couple of minutes on kind of your overall thoughts on the topic and either end of the spectrum, whoever's ready to rock and roll.
I can jump in. So just overall, in general, if we're looking ahead to 2019, is that kind of where you're going with this, Rick?
The
Background?
topic is acquisitions, and so kind of a couple minutes on wherever you want to take the conversation as it relates to your specific category.
Sure. So really, when we talk about M&A, I'll use the term M&A. I think one of the focal points is QOE, or quality of earnings, and that's where I come into play. Generally, once a client enters into, depends on the client. We either come in on the search fund phase, we'll help them kind of with the LOI along with an attorney, kind of structuring the LOI or letter of intent. Once that is signed, we're usually the first people with boots on the ground going in and investigating these companies. and kind of looking at normalizing EBITDA, or earnings before interest, taxes, depreciation. So generally, I'm either the good guy that keeps the deal moving forward, or I'm the bad guy that can kill the deal and maybe negotiate a purchase price reduction, and Dean would help out with that. We've had a lot of those instances over the years, but hopefully we're on the positive side of those. That's a win-win for everybody. And quality of earnings, I think, is really important to do either right at the transaction stage where you've signed that LOI, or when you're thinking ahead 2 or 3 years, and do you potentially want to sell, and getting your business in compliance with GAAP, identifying all those non-recurring expenditures, such as personal items being run through their business. Doing that on the front end allows for a smoother quality of earnings for all parties involved. And we're certainly seeing a significant uptick in that in the last, I'd say, 3 to 4 years in my time.
Great. Melissa?
Yeah, so the lens that I look through obviously revolves around the financing side, and the decision for one company to buy another could be a roll-up strategy like Dean and Rick mentioned. It could be taking out competitors. It could be diversifying like Dave mentioned. There's many reasons that a company may look to buy another one, and so we just really dig into sort of that company's existing financial position, what makes sense for them, along with 3 to 5 years of financials for the target that they're looking to buy. And then almost more importantly, the post-integration plan. How are those two companies going to meld together? Does it make sense? And then on the individual side, I work with a number of individual buyers who are more financially motivated, and they're oftentimes what I affectionately refer to as corporate refugees, where they've been doing the travel, they've been at a corporate job, and they just really want to buy a company. And that may be in sort of that 3 or maybe even as low as $1 million, but more on average, kind of that $3 to $10 million range. And so we'll work with them to really figure out kind of where their expertise is, what their background is, their experience, what transferable skills they may have from that corporate job to apply to a small business, and then again do the analysis on the targeted company, work with the seller to put together a budget and make sure it's sensible. And sometimes companies, individuals will approach us about buying a division of a larger company or a location for a business that might have 5 to 10 different locations. They want to buy a piece of that business, and so we'll work alongside someone like Ryan to really look at those extrapolated numbers and say, does this make sense? You know, what are you actually buying when you're getting this one location or this one specific division of this business? Those can be really tricky to analyze. And so it's been really interesting the past few years. I would say the lending market has been frothy. There's a lot of credit availability, interest rates are low, and so for those of you that are buyers, I would encourage you to shop around for lenders. Not a lot of banks do cash flow based loans, especially smaller business banks, so there are some nice options out there for buyers, but it does make sense to look around.
Great, thank you. David?
Early in my career, I worked with a fellow whose idea of corporate development was that he caught them and then I got to clean them. Which my experience since has turned on its head. That's just the wrong way to think about it. We're going to talk a lot here probably about the deal activities and how do you get things done. And that is really important, and it is a lot of effort, and there's a lot of homework that needs to be done. There's a lot of things to understand and think about, but to use a football analogy, switching sports, the deal, when you get it signed and the money changes hands, that's like the opening kickoff. Everything that comes before then, selecting the players, the training, developing the playbook, getting the game plan together, all of that stuff, that's like you're developing your strategy and you're doing the due diligence and all of that kind of stuff. You get the deal done, it's a big event, but then you got to play the rest of the game. And that's where you're going to judge your success by. You're not going to look back and say, gosh, Dean, that purchase agreement you drafted was pure poetry. That was wonderful. I've never seen anything greater than that.
I hear that a lot, though, Dave.
Yeah.
Yeah,
it's good.
and I've
It's
done
good.
that too. So they are wonderful.
And you'd rather hear that
Right.
than it was poorly crafted and you left big holes in it that caused risks and stuff like that. The design and structure are very, very important. But when you're going to look back and figure out whether a deal was successful for you or not, it's going to depend on what it ended up doing for you. Did it meet your objectives that you had going into it, either financially or strategically? And that's where the importance of doing the proper assessment work and homework and research up front and figuring out how to get the right help to ask the right questions and make sure you're understanding what you're getting into, putting the deal together and the structuring and the financing and making sure you understand the numbers and having projections that you feel confident that you can go out and meet. All of those are really, really important, but then you need to be able to execute. And that's how you're ultimately going to judge your success. And that's the hardest part, I think, in all of it. But they're all important elements. There's no one of them that if you don't do well, then it can still, you can still work, but you're not going to be as satisfied. So.
Dean.
So I've been telling clients for about the last 4 years that they got to get out now if they're going to sell, because this is the best M&A environment that most of my colleagues have ever seen. Some of them that have heard that year after year after year are probably wondering what I'm talking about because it continues on. But I've had the misfortune or good fortune, depending on your perspective, of seeing a couple market cycles. And I remember guys in their 60s in 2007, 2008 saying, "Oh, this will, I just want to just a little bit more, maybe $1 more million of EBITDA, and then I'm going to sell." 10 years later, they're stuck. They got stuck in the business, and they had to ride out the next market cycle because that last little bit didn't make that much of a difference. But between the low interest rates, which Melissa mentioned, and the enormous amount of kinetic activity in the deal side, it's been a fantastic and a fun M&A market for the last few years. The other thing I think that can't be ignored is a generational shift. As the baby boomers who started businesses in the 80s, 90s, 70s, 60s, and are getting to the point where they're ready to get out, they're ready to be done. It's been a real fantastic market. I agree with Dave 100%. I think when you get into the integration side, that's where the rubber really meets the road. I think really savvy acquirers on the front end spend a lot of time thinking in terms of what the integration looks like after they close. Not so much, okay, this is attractive, this is a sexy target, I think I want to make sure I have it. And sometimes people will, if they realize, this isn't going to work, either from a personality fit or from a business connection perspective, if they're willing to say, I've made this determination, it's not going to work before they close. That's knowledge of forethought, because if you get into it and you're into a bad marriage, you can do an awful lot of damage to a business. On the other hand, if you did do a fantastic deal, you realize all the synergies you thought you'd be able to realize. The people that you brought on are all additive to your business. It can be a fantastic growth model, but it's not without risk.
Great, thank you. All right, so I have a couple of questions for each one of the panelists, and then I have a list of questions for the entire panel. If along the way folks have questions, please raise your hand. So David, let's start with you. You've been at Deluxe doing deals for about 20 years. I've been in your office, had a great conversation. The whole windowsill is filled with Lucite Tomb Tone, so you've been quite active. How have your goals and strategic intents for deals changed over time, and if they have, why?
Good. Thanks. They have changed. Early on, when 20 years ago when I arrived at Deluxe, we had a few things going on to try to take us in some different directions, but by and large, what we then called the paper payments systems part of the business, where we put little rectangles of paper with magnetic ink on them, and you fill in the rest of it, and off they go, which is still an important part of our business. We knew we needed to be doing more than that and have a much more deep relationship with our clients, things that would be in more organically growing spaces, things that would stretch our capabilities and take us way beyond just printing or something else that seemed really, really close in. And so we set out with objectives of what else could we do that is credible to our clients. In other words, they would believe a story that I could buy this product from Deluxe in addition to checks and deposit tickets. something that we could learn how to do readily. And how do you end up doing that? Well, you can, it's the old build, buy, or partner story, right? And buying, as we'll talk about a little bit more here as we go along, is a way to get there faster. It's a way to get talent overnight. It's a way to get into market spaces, again, overnight, rather than a slow build and slogging it out competitively to end up with platforms in new places that then you can use to build around. And so the early stages were about creating and finding those growth platforms that were within a good adjacent space for us that was credible to our clients. And then as time has gone by, having those platforms in place has allowed us to fill in gaps, to add on, to build more and more scale, as well as to ride along and participate in, and in some cases, get ahead of the curve and be a leader in some of the technological developments and the new product development in those spaces, building on some of the strengths that we had built over 100 years previously in doing that in other marketplaces. So that's where our objectives have changed, is first starting out looking for the platforms, and now looking for more of the growth opportunities to build on what we were able to establish by having those growth platforms in place.
And then in terms of the acquisitions go, how do you build your deal flow, and how do you go about proactively targeting companies and finding acquisition candidates?
Yeah. Rick, the key word there is proactively. My phone rings and my email makes whatever sounds it makes on whatever device I'm using all week long with inbound prospects of other companies that are for sale. Because we've established relationships with a lot of investment bankers and business brokers and other people who are assisting companies when they want to sell. And if they think that Deluxe might be a potentially logical candidate, then they bring those in. And so part of it is just making sure that I'm in those networks and I can see the deal flow and be able to assess those. But the most important part for us, and where we're most successful, is where we start, in my case, working with my internal business partners in the various divisions and product areas that we have, and helping them develop their strategies about where they want to grow, where they feel that they have gaps to fill, and where an acquisition or two or three could help them get there faster and better. And then doing our homework. Who's in that space? Who's winning and who's not? Are there different business models that are in place in those spaces that seem to be ascending or descending, and figuring out how they're going to play and work alongside the other things that we do? Are they compatible business models from a sales and go-to-market point of view, or do they interoperate with other products and services that we have? And all of those things come into play in figuring out where those spaces are that we're going to go after, and start to make calls to people who might not be thinking that now is the time to sell, but could be convinced if we have a good, friendly conversation with them. Tell them the story, get them a little more excited about how we could do more together than we could separately. And so that proactive reach out and the homework and the strategic backdrop that goes with it are really important.
Great, thank you. Ryan, let's jump down to you. Again, you're in the transaction services practice at Boulay. You're working with private equity search funds and strategic buyers. Your work does the quality of earnings reports that you mentioned. How have Q of E reports expanded in scope and focus over the last 5 years or so?
Mm-hmm. Yeah, it's a great question, and I think really the way they've expanded is the amount of details that we're getting into on our reports. So 5 years ago, mainly focusing on working capital, kind of normalizing that for the last 12 months or TTM period, and looking at seasonality within that working capital. Looking at the numbers more so, and EBITDA the same thing, looking at the last trailing 12 months of EBITDA. Now we're really getting into, and along with the numbers, more so analysis on the financial analyst side of things. Charts and graphs start high level to look at where do we see these inconsistencies. So if there is seasonality, we'll see these peaks and valleys throughout it, and then we're tailoring our procedures on the front end. So we do this analysis, and then we'll focus on those areas in the due diligence when we're focusing on writing our procedures with the prospective buyer, or if they're doing a sell side diligence. And then as far as from our point of view, diligence in general over the last 5 years has the timeline squeeze on us CPAs seems like it's getting faster and faster because buyers want to move faster and faster. So that has its own challenges when you're working with a team of people and getting everybody on the same page and having conference calls at some ridiculous hour at night or early in the morning, especially when you're dealing with East Coast, West Coast. But that's probably the biggest driver with that regard. So instead of 3 to 4 weeks to get a deal done 5 years ago, now it's maybe 2 weeks. We've turned a deal around in as fast as 7 days, and that was a long 7 days.
Puts a little stress on the home life, I'm sure.
Yeah, a little bit, but there's a light at the end of the tunnel, and it's a fast-paced environment, as I think most people up here would acknowledge. But the challenge is it's fun chasing and really adding value to help navigate the waters of a transaction and helping people close a deal. So.
Okay. So why does a business owner need a Q of E report, whether they're selling or buying, and why can't their current CPA do it?
Mm-hmm. So the current CPA, it really depends on what size firm you're currently with. More often than not, if we come into a deal, so I'll focus just on search funds or independent sponsors, or like Melissa mentioned, maybe it's those high net worth individuals looking and going and buying a business. Those deals are typically a little bit smaller. And it's important to have a reputable accounting firm do that quality of earnings report if you're representing the buyer. Because if you don't have that reputable firm doing it, then you might not get the quality information you want out of it. And more importantly, on the sell side, if your current CPA does it, they're probably, from an independence perspective, they can certainly do it, but is it going to have that same meaning as an independent accounting firm coming in and kind of looking at it from an honest perspective on the outside, looking in, not knowing that business at all, and giving their honest assessment of where things are at with the business? I think there's a lot of intangible value there, depending upon the size of the deal and who your current accounting firm is. If you're one of the big four or a nice regional size firm, there's departments that specifically do transaction work. So you might have a good name on that report, and you're getting the same value as you would if an independent person would come in, but there's a cost to that. So just making sure you know who the transaction players are in the market and who can deliver a good quality of earnings, I think is really important.
Great. Dean, let's jump down here to you. I know there's a number of companies and folks in the audience who are considering making acquisitions. What are the more significant capabilities that a company should have when they're considering their first acquisition?
So, when a lot of times with a company is, not like Deluxe, who's not, you guys have probably a functions within your team to allow you to do this, right? Your job, people around you that can help do an acquisition and go through the process. But a lot of smaller companies frequently don't, right? They're operating, as leanly as they possibly can. They have their people, but usually their people are doing their job and parts of 2 to 3 other people's jobs because they just don't have availability. When those companies go to acquire another business, they have to then take the next step and say, okay, well, now the different people in our group have to wear a different hat, right? And some of the most important ones that you run into are your CFO, anyone in your finance function. They're often going to be involved in diligence. They're going to be involved in interfacing with professionals and accountants, and they're going to really have a whole set of additional responsibilities in addition to the day-to-day activities that you kind of expect them to do to keep the company rolling smoothly. As you get down the process, your HR function, they're going to often be involved in human diligence, and they're going to be involved in trying to figure out, okay, how do these people fit into our org chart? Because in many respects, you're a lot of times bringing organizations together. Obviously, sometimes depending on the organization, they want to understand how their personality fits. They'll want to get deeper and assess whether or not there's going to be connections. Who's the right people to run individual departments or divisions, depending on the level of integration you have in mind. You're going to have other questions involving real estate. obviously technology is a very big deal today, and if you have a pretty significant IT department that is involved in development things, you can make assessments on the other side's intellectual property and tech. If you don't, a lot of times people will go out and get an outside resource to do IT due diligence so that they can see, okay, what's really going on with this software. A lot of times people do it in-house, but then they have to call upon their internal resources to say, okay, I know you're keeping our system going, you continue to develop these products, but I also need you to go look at what's going on over here and really understand, are we buying spaghetti code, or are we going to be buying something that's is a really robust platform? Because if you buy a company and all of a sudden you have to throw $2 to $3 million of additional IT spend after you're done, that's probably something you didn't budget for. Of course, solid professional advisors are important, obviously, not to pat myself in the back, but you do run into situations where if you have counsel or an accountant that hasn't been through the process before, they can be an impediment to active service. So it is nice to make sure that you deal with somebody, you have, sometimes people bring us on as specialists who can actually handle these acquisitions if they're sort of regular accountants don't do that, or regular attorneys don't do that work. Same thing on the accounting side, and like Ryan mentioned on the Q of E side. But I think it's important, to some, that you look throughout your entire organization and you say, okay, really, are we poised to be able to do this and do it well? Because you don't really want to get into it and start missing deadlines, and then you start missing expectations with the seller, and you end up with a position where the deal is floundering because you're really drawing on your own internal resources more than they have capabilities. Because there are firms, there are outside consultants that can help on the diligence side, on the integration side, that can be very important, but you do need to be ready for that, because you will stress test your organization if you haven't been through it before, or if you're used to smaller acquisitions and now you're going to do a big one.
Yep. So stick here with you, Dean, but Ryan mentioned earlier challenges of meeting the timing on some transactions. You mentioned impediments to deals closing. Maybe go through some of the common hurdles to getting a deal closed.
Well, I would say probably the first one that gets in the way is expectations. A lot of times you'll have a seller who, they want to get out of the business, they want to get out, or they want to come in and integrate into your organization. And, you'll have this idea, okay, I really want to bring this company in, and I'm going to move quickly, and I'm going to be agile and look like we're moving forward. But a lot of times you run into situations where people maybe not be on the same page at the beginning, right? So obviously, as lawyers, we try to encourage people to do a more detailed letter of intent so it doesn't fall apart later. Sometimes clients want to move past some of those details, and all of a sudden they find out that people weren't really on the same page to start. That I think is kind of important, because if you can make sure everybody's okay with expectations around timing, the timeline's realistic, what the costs are. Sometimes with certain types of sellers, you need to make sure that they understand what their after-tax proceeds are going to look like. If they're looking to get a certain amount of cash from the deal, that they're actually going to, because a lot of times if somebody's thinking about retiring, their financial advisors say, you need X dollars to live, right? Well, if in the course of the process they're not going to get X dollars, you have a problem. You have an impediment. And so I think the first step is understanding expectations. I think that's very important. The second step is sort of the flip side of what I mentioned about the capabilities that you need to have on the acquisition side, is what the capabilities that the seller has to have, because your accountants, your lawyers, your internal people are going to put a lot of pressure on the seller. And a lot of times, if it's a larger company acquiring a smaller company, the smaller companies in a situation where they also are, they have their CFO doing their CFO stuff, and they have their, HR people doing their HR stuff, and now people are calling them asking for information and to help with disclosure schedules and setting up meetings, and all of a sudden, like, the stress on that seller's organization starts to get put higher and higher and higher. A lot of times the buyers look at it and say, well, why aren't they sending us information? And the seller's saying, I have another job to do. And there's always that sort of natural tension. And so to kind of go back to what I said earlier on expectations, having a realistic timeline that anticipates what the seller's needs are and what the parties are going to do and sort of stick to it. A lot of times a Gantt chart is really effective to understand, okay, this is the window we're going to do this, and this is the window we're going to do that, so people can start to plan their day effectively. But as you start stressing the seller's resources, stressing the buyer's resources, personalities come into play, stress comes into play, and then tempers start getting frayed. And I would say as many deals that I've seen go sideways have gone sideways because of the fundamental issues like price, fundamental issues like the earnings and things like that. As many issues have come up on the stress side, people just start. It's a human business, right? And whenever you're selling, it's probably one of the most stressful. It's fun stress a lot of times, but it can be very stressful on individuals, and that can create a lot of friction in a deal. there's, I'm sure a lot of them, but we only have an hour and a half, right?
Dean, are you seeing people potentially getting paid? So if I'm buying the business, the buyer's paying the seller for that business interruption at all? If it's a smaller business and they're getting squeezed, are you seeing that built into any LOIs at all, or not really?
I personally haven't, because it's not as intrinsic in value.
Right.
What I have seen is people thinking through setting up, signing bonuses, either stay bonuses for critical people that
Right.
that need to stick around, or signing bonuses so people get excited for coming on. A lot of times you're thinking through, okay, you look at a business and you see, their exciting customer base or their technology base, whatever you're looking at, and you see this human capital, and sometimes you see people stand out, right? It's kind of interesting. A lot of times you see the seller is a really active alpha type. They start to take steps back, and you start to look around, and you realize that the step 2 or step 3 management, there's some real superstars under there that might be underutilized. So I've seen, buyers are willing to, sign them on more on the front end of the comp side, but I personally haven't seen them, agreeing to pay for the interruption. I think they're focused on the intrinsic natures of the value of the business.
Great, thank you. Melissa, you and I talk regularly about financing acquisitions, particularly in the lower middle market, and I know everybody has their own definition of what that means. At Highland Bank, it's kind of 1 to 10 million-ish. But what are the main types of bank financing that happen in these types of transactions?
Sure, yeah. So the two general types of loans out there would be a conventional loan and an SBA loan. And as Rick said, in that $1 to $10 million range, those are the types of loans that we're looking at and our buyers are considering. And there's a few aspects that sort of make us lean one way or the other with a buyer. And sort of the top 3, I would say, would be the equity or cash in that a buyer has to put towards a deal. That obviously influences leverage ratios and cushions and that sort of thing on the cash flow. It's also going to be the cash flow of the business. So looking at the industry that the business is in, how sensitive is that cash flow? Is it recurring? Is it over-reliant on a couple key clients? Is the current owner responsible for key relationships that may be at risk after the deal closes? So it's really looking at the cash flow of the business, and the stronger and more reliable it is, may shift towards conventional versus SBA. And SBA just means there's a government guarantee attached to the loan, so that helps the bank sort of mitigate some risks. The other piece would be the collateral. So how much collateral is on the table for the bank to take in conjunction with that loan? So a service-based industry may have receivables, but they're going to need a line of credit, so the receivables would likely go to the line of credit. So what's available in terms of collateral? Probably not much. Maybe a good candidate for an SBA loan versus a manufacturer, which may have a good amount of hard fixed assets that the bank can rely on for a tertiary source of repayment. Then again, that may shift or lean towards a conventional loan. So looking at the opportunity, evaluating, kind of makes the bank lean one way or the other. And a couple facets of an SBA loan product that may be worth thinking about is if you know you're going to be a good candidate for an SBA loan, it's important to work with an SBA preferred lender, because that bank can do the loan and approve the loan without going to the SBA. They can approve it on their behalf. And the other aspect is there has to be a personal guarantor with an SBA loan. Some of the other cash flow loans that we do, Rick, don't have as many personal guarantee requirements, but on the SBA side, it's pretty strict, where any owner with 20% or more interest has to provide a personal guarantee on. And in some of the deals, there may not be a 20% owner, a majority owner, and so someone has to be willing to step up and provide that guarantee on the SBA side. So just a couple items to keep in mind there.
Sure. And once you've engaged with the company, what does the bank's due diligence process look like, and what are some of kind of the common questions that you would ask a company when they're going through an ownership transaction?
Sure. Yeah, so some of these items I covered, but really 3 to 5 years worth of financials. We also look at the quality of the financials. So are they compiled? Are they reviewed? Are they audited? Is a Q of E going to be required? The threshold sort of out in the industry is 2 to 4 million of EBITDA would push it towards a Q of E, but we've seen Q of Es or asked for them when there's other sort of nuances like completion accounting, costs in excess of billing, billing in excess of costs, if there's intercompany aspects happening and they're not really accounted for, we're going to want a Q of E with sister companies. So yeah, the quality of the financials is one piece. And just on the individual side, it's really navigating, as I mentioned at the beginning, is that owner going to be successful running that business? And that can be hard to figure out. I financed a gentleman, high net worth individual, corporate, and wanted to buy a business, and he had been responsible for a large division of a company and bought a business, and a couple months in decided that wasn't what he wanted to do. It turns out managing 16 people here locally, including millennial generation, was a lot different than managing 300 people in India. So it's really,
Who knew, right?
who knew that could be such a change? So it's really working with those buyers, making sure they understand the culture of the business, that they're willing to work in the business, and then identifying gaps of when the owner leaves. What's the skill set of the key management team? Are there contracts in place? Some of the things that we look into are non-compete agreements, could be a lease on the building, whereby it's oftentimes the owner of the business might own the building. And so after they sell the business, when does that lease expire? And if it's going to be in the next year or two, what's the probability that the rent could increase? And then we've got an unforeseen expense there. So it's not much different than what the buyer's doing, but it's really just kind of talking through of all of those issues and making sure that their emotions are in check and they're really being thoughtful about all the financial pieces. And then in terms of the projections, it's having them work closely with the seller, talking through what does the future look like and are those projections realistic? And with regards to discretionary expenses that Ryan mentioned, sometimes they're legit, other times you raise your eyebrows a little bit. So I had a client looking at buying a manufacturing business, and that seller also owned a robotics company. Well, the seller was claiming that a bunch of the legal expenses and insurance and SG&A, they were running the robotics company expenses through this manufacturing company to offset the income. Well, that could be true, but really working with them and working with their accountant, asking those questions about the add backs, because that has a huge impact on the valuation. So that's some of our role.
Great. Question in the back, Ward.
When you're looking at an acquisition from a bank point of view,
Yep.
do you like to see the projections as the buyer, when they integrate, all the profits they're going to get as they go forward? Or is it better for you to just see zero growth and the deal works? Do that. Don't even worry about what we think we can do with it.
That's a great question and could be about a half a day just on doing projections alone. But what our clients commonly do is sort of a best case scenario, a status quo, and maybe a sensitivity, a worst case scenario. Let's say there is a recession or interest rates rise or expenses increase. We sort of get these different scenarios. And then the first 12 months, it's more of a cash flow based projection, especially when there is receivables and others, where we just are really drilling into that cash flow. And then the following 2 years, it's more of just an annual kind of what does it look like at the end of that year 2, year 3. And we do like to see it, if it's one company buying another company, we like to see them merged. I mean, what does it look like together? It doesn't do us any good to see it kind of on its own. And we don't want to see pie in the sky, but we also don't want to see, we want the numbers to look good enough where we have it in our file, the regulators come to look at our file, it looks good enough, the decision made sense. We don't want to see it bare bones. Is that helpful?
3 years or 4 years or?
Yeah, so, yep, good question.
Was it, Ward, was it
terms.
terms on a loan?
Yeah, the loan.
Okay, so for anybody who didn't hear it over here, terms on a typical loan.
Yep. Yeah, so on the conventional side, we'd want to see the loan repaid in 3 to 5 years, and it, again, depends on structure. And for private equity, there's probably going to be a cash scoop in play where excess earnings get paid down to that principal. On the SBA side, again, because of that government guarantee, we have a bit more flexibility. Oftentimes, those loans are out 7 to 10 years.
Okay, great. Thanks for the question, Ward. All right, so shifting gears to questions for the entire panel, whoever wants to tackle it first, and then whoever wants to contribute to any of these questions, feel free to do so. Magic question that came up, and I heard it a couple times just in the networking here beforehand, is where do you see the M&A market headed over the next year or so? Magic question, always the first thing that somebody asks.
Go ahead.
Okay, so this was a fun one to get, and I had to sort of think about it and look at my pipeline this year compared to last year, and I did make a couple calls to some of my brokers, investment bankers, attorneys, just to kind of get a pulse on what they're seeing. And it's interesting because although it is still strong, credit availability is still good, interest rates are low, we're seeing a little bit of a slowdown. It's just starting to slow. There's a little bit of a trepidation. People are being a little bit more thoughtful, and sellers are having to give just a little bit more. I would say it's definitely still a seller's market, but we're seeing a little bit more seller financing, so earnouts, warrants. The sellers are just having to participate a little bit more. So I wouldn't say it's a slowdown by the nature of that word, but I'm just saying things starting to turn a little bit. And I'll also mention just sort of a market observation that I said private equity before, the last couple of years, for anyone a buyer, anyone looking to buy a business? Okay, so you know that, you are, yeah. So you know that private equity has dipped down to the lower EBITDA range. I mean, it used to be where 5 million or above, maybe 10 million, but private equity's really gone down to that $2 million EBITDA range, just because they've got the capital they need to deploy it. And so it will be interesting. In fact, we financed a private equity deal in the fall of last year where the company barely had $1 million. It was just over $1 million in EBITDA and private equity purchase. So I'm interested to see if those thresholds are going to move back up, if private equity is going to pull back a little bit. Haven't seen it yet, but just sort of an observation that way.
I'll just add on to that a little bit. I think a lot of the factors have been brought up by all of you as we've been talking about, interest rates being low. There's a lot of money out there looking for deals and for things to do to grow either their funds or their businesses. There's a lot of good things that are creating interest. Multiples are high. It's a nice time to sell if you're in a position to sell. But at the same time, we have seen erosion of confidence. And ultimately, buying is a reflection of your confidence level in your strategy and what you want to end up doing, and that's a good time to expand. And whether you follow the NFIB optimism statistics, or whether it's the conference board or the University of Michigan surveys, or the market or the purchasing manager surveys, or all of those things, we've seen confidence erode. It's still okay, but it's come down from the levels that it had been. And as a reflection of that confidence level in people wanting to make bets on the future, in the immediate future, we're seeing a little bit more softness that could end up translating into a little more softness in the M&A market going ahead.
So I'd say from a deal flow perspective for us, this is the busiest we've ever been on the M&A side of things, and maybe that's due to the marketplace that we're in with search funds. It's typically the smaller size deals. And the private equity groups we work with also play in that same space. So I think they're more strategic about deploying their capital because multiples are higher than they've ever been. I'm working on a deal right now where the multiple is 7 times EBITDA, and financing has been an issue, as we were talking about earlier. The senior lenders may be willing to go 4 times EBITDA, and filling that last 3 times with mezz funds is challenging. Because everybody has to meet their own IRR covenants to their investors, and that can be an issue in and of itself, but at the same time they also don't want to return capital to their investors. So I think it's still going along steady, but I could see a dip here, depending upon how the markets go, but there's plenty of activity out there. No better time to be a seller.
Dean, anything to add?
Well, it's the year to do it.
All right.
Because you can always change. But no, I in my experience, similar to Ryan's, it's the busiest we've ever been. I think the only thing I would add to think what maybe Melissa said is, it's distinctly possible that a lot of the quality, the maybe the higher tiers of sellers have sold, right? And so now they may be chasing some sellers that they might otherwise have chased if they hadn't been in need to do an acquisition, or if they weren't actively seeking for add additional capabilities.
Great. Next question. We often hear about companies getting ready to sell. What's the corresponding, or is there one getting ready to buy?
I would say absolutely yes. And Dean, I think you touched on it earlier, and some of the other comments are indicative. It takes a lot of work to not just do the deal, but to figure out what it is you want to do and to execute afterwards, and to have resources in place and available, especially resources that you trust their judgment and trust to get things done. It takes confidence, and it takes work, and it takes the ability to think forward about what are those workloads going to look like, to help figure out how are you going to get through the deal cycle and manage the work when you have people sharing jobs, or taking their day job during the day and filling in odd hours to try to get their diligence done and their planning figured out, and a more detailed execution plan sorted out. All of that preparation around the resources required, what you can do internally, and what you need external advisors and helpers to get engaged and help you with. It takes some forward thinking and some real honesty about the capabilities and capacities of the team that you have, and how that maps up as well with the objectives of what you're trying to achieve and what it's going to take to be successful with that. So there's definitely some forward thinking and resource allocation thinking that goes with it to be successful with it.
Go ahead.
Oh, I was just going to say, yeah, and preserving that personal liquidity or business liquidity. If you're looking to make an acquisition in the next 12 months, 2 years, 3 years, now as a business may not be the time to develop those 3 cost centers that have been on your mind with innovation and research and development and ventures. Now would be the time to really retain that cash so you can put it towards an acquisition, along with keeping a backstop, because there's always unforeseen expenses, bumps in the road, a software implementation you need to make, a key person hire, a website revamp. So preserving that business or personal liquidity. And then personally, just doing a risk tolerance assessment, doing an analysis, being prepared. I know Joshua's here from High Performance Group, and they'll work with buyers to really do that analysis. I've talked to buyers who have said, yeah, I've looked at 150 companies, or I've been doing this for 5 years. I've been trying to buy a company, and it's like, you are not gonna buy. You have not done a risk assessment. I mean, they're too afraid. They're just spinning around on deals. So really understanding how much cash you're gonna put in, what does the deal need to look like? Do you have the personal risk profile? What is the deal gonna look like for you? So doing that analysis, and then talking to your lenders. So Ryan mentioned he's working on this deal. They're deep in the weeds of accounting, and the buyer doesn't have a mezz lender. So it's like understanding what are those ratios that you need to fit into, who's going to provide the capital for you, doing that research ahead of time. It is difficult to get pre-approved, but having those conversations with a lender so that you know when you get into the weeds that you can get the deal done.
And I'll say a little bit different angle on the sell side. If you're looking to just sell to sell, I'd say that you can move it pretty fast. I would say if you're looking for a more strategic, to kind of keep the legacy around, take care of your employees, that could take a little bit longer to identify that strategic buyer. But those are all factors to consider. Maybe more than 6 months before you want to sell the business. Now, start now. Plan out 5-10 years down the road. What is your plan? And I would hope that your trusted advisors are starting those conversations, because it's never too soon to start them.
Yeah, I would say where it kind of depends on the type of buyer, but a lot of companies, they will decide they would need to buy something if they realize that they've hit some kind of constraint They either need to add additional capability that they don't have. They're finding it harder to continue to organically develop customers and think that it's maybe an easier path to go acquire a business that has kind of some of the customer base. That's one type of potential buyer. I think another type could obviously be a private equity fund that's going to add some bolt-on, a private equity portfolio company that's going to start doing some bolt-ons as part of their acquisition strategy, or there are just simply companies out there that are intending to do a roll-up. But I think one of the other things to consider too is the timeline of the owners, right? If a guy is in his 60s and wants to get out soon, he's probably not going to be a buyer, right? If somebody's has a little bit more mature business, some stable cash flow, ready to make an acquisition to continue to grow, those are going to be particularly attractive people. Similarly, on the portfolio side for the private equity funds, I mean, if they're probably not going to do a deal in the 6th year of their ownership because they're going to be thinking about an exit and they don't want to have to put all those integration costs onto their EBITDA, because they're going to want to have generate as much cash flow as they can when they want to sell. So some of it is life cycle, just simply company life cycle.
Okay. What if growth is not the main goal? Do acquisitions have a role in strategy? I know David talked a little bit about strategic intent at Deluxe, but I'd like to hear from the audience or from the panel about that.
Yeah, certainly, while growth might not be the main goal in some cases, there are situations where a deal can make a lot of sense. In some cases, it's a competitive question. Is it for a defensive purpose? You don't want X, Y, or Z of the bad guys to acquire this particular company because it will do certain things for them that would place you at a disadvantage, and conversely, you'd be better positioned if it was part of your organization. And so you may end up secondarily ending up larger than you were before, but the primary motivating factor would be more of a defensive and strategic posture rather than a growth posture. In other cases, we've seen situations where it's more about talent acquisition and remaining competitive that way. It's a faster way to find people who are involved in a space, perhaps recognized as leaders in that area, and you can make them your own through doing a deal. And again, maybe they have a business that's got revenue and profits that comes along with it, but it's what else those people can do for you as you're looking forward, and to have your business remain vital going forward. That would be more the primary motivation there. As two examples, you could make lots and lots of other ones.
Yeah, I'd add one other one that I've seen that is kind of become more interesting as things continue to evolve technologically. Is people, I think they have a stable size, nice business, go in the right direction, they're making money, but they see the horizon and it doesn't look. There just isn't a lot of opportunities to continue to grow, or they're expecting to shrink over time. I've seen companies make acquisitions as a strategic pivot to get into a different business where they think have more opportunities in the future, and invest some really significant resources into doing that. It's a very different type of acquisition, because in many respects, it's maybe tangentially related, but it's not as related as if they did something that was a true peer-to-peer. And it can be a lot more interesting. But I've seen some really interesting in the last few years as retail changes in particular, but also food ingredients and all these different sectors that people have decided, I have to make a pivot, I have to make a change, and then they go into a different direction.
Yeah, and I'd mention too that there's the defensive strategy, and also could be that a client just doesn't have the capacity to do what they want to do. So last year I had a client, a home health business, and they want to add a hospice component. So rather than taking internal resources to apply for the hospice license and go through that process, they ended up buying an assisted living business that had a hospice license. So it could be a capacity, and it has been employee issues too. I was talking to a broker, and he mentioned that he has a service business listed, an IT service company, and doesn't cash flow well, but he said, I know I'll sell it because somebody's going to want those employees, a strategic buyer. And arguably that's why Bright Health, a health insurance company, bought SpiderTrap, which is a web development company. They wanted those coders, they wanted that web development. And then you think about even big companies like Facebook. I mean, had they not bought Instagram, they certainly would have shed users and lost all of their equity value So buying a business could be more about the rationale of playing defense and staying in the market, and it's not always about the cash flow and sustaining the cash flow, but it can be working on the defensive aspect.
Go ahead, Rick. Next question.
Next question. All right. What are the challenges of executing an acquisition well, and when is the right time to bring in outside help?
The challenges, I'd say, depend on the deal. Like Dean mentioned earlier, one of the bigger challenges is if you're dealing with counsel or a CPA who hasn't went through the process before. On actually the same deal that I was talking about earlier, the multiple of 7 of EBITDA, the seller's CPA was trying to argue that working capital should be X, and we were saying more because they were including the line of credit. And when we looked at it, it's like, well, we use the line of credit to pay payables. Well, that's a financing activity, and this is a cash-free, debt-free deal. And we just couldn't get over that hump. And finally, I think the seller's counsel came in and kind of advised that, well, no, you're wrong. Boulay is looking at it from the right angle, and we got over that hump. But that's probably the biggest challenge or the biggest frustration point that we typically see in some deals.
Yeah, I guess just personally, it's relatively low cost to get people, get advisors spun up early if they're efficient and smart about it. And so the sooner we can get involved, personally, I think it's best because we can help and give different perspectives. I mean, there's been a situation where I just can think it off the top of my head where where a buyer and seller were kind of at loggerheads, and you probably heard about it, but representations and warranty insurance is a dynamic market, and it's become more and more of a useful tool down market, and I don't think they either had familiarity with it or they didn't know that it had come as far down market as they can, or that the cost had come down, or the ease and availability of the product. And so without adding a lot, I said, well, this is one way we could bridge the gap, and that was enough to get them passed into the letter of intent and get the deal moving forward. And had we been involved a little earlier, we could offer the advice a little earlier. But I think that's, I would say that it's often worthwhile to have a couple other trusted voices in there earlier, and anytime you have an expert that has a little more experience, because this is what they do, they often can add a little bit more value on the front end than they could later on after a lot of the decisions have been made.
Yeah. Just to reinforce the point, I mean, the front end planning, getting the team figured out with the right amount of expertise, good realistic expectations about the role that each party plays, the amount of time that they really have available to assist with the prospect, especially when we're talking about internal resources, but certainly we want to make sure we get the right external resources involved as well. Many times in our cases where we're bringing in outside help, it's to make sure that we've got an expert in a particular industry, or if it's our either financial or legal advisors, are they conversant with what the terms, the business models, the risks that you're going to find in certain areas, and having people who have seen that over and over again and can advise because they just know it like the back of their hand, as opposed to having to go and research it, is very, very helpful. Especially, I think geography was mentioned earlier too. And as we've done deals in other parts of the world that we hadn't participated in for the first 90 years of our history, it's been really, really important to find people either on the ground or who are expert in dealing with just the basics of doing business in some cases, in our case, in Europe and in Australia and in South America and places like that. The rules are different, and you can't just assume that they're going to be pretty close.
Yeah, and I would say at the LOI stage, it does make sense to bring in your lender. I mean, you'd hate to issue an LOI that you can't stand behind, or put in some terms that aren't going to work with the lender. For example, earnouts aren't allowed with an SBA loan, so you'd hate to work hard on this LOI, get the earnout all buttoned up, and then find out, well, I'm actually going to need an SBA loan, and we have to change this all together. So working with your lender, getting an affirmation that the deal can get done makes sense before you issue an LOI. And then working closely together through that due diligence and purchase agreement phase.
Great, thank you. Question over there, yes.
Yeah, so you mentioned technology before. When dealing with an
So the question over here, if you didn't hear it, was if the acquisition is technology-based, in particular software, but you're not a software development firm, or your business isn't based in software, how do you go about assessing the technology?
Yeah, there are outside there are outside consultants that we have relationships with that we will bring in to help do the tech diligence. They have some knowledge on infringement, but not a lot. So we sometimes will bring our intellectual property people in to review that. It's harder with code. I mean, because of the nature of the software. When it's copywritten, you don't necessarily know if somebody else's copywritten code is the same as yours, unless it's literally, it's actually copywritten with USPTO. But they can, if you find a firm that has experience in that market sector, they're often able to say, well, there's a few other areas in this, a few other types of software that are kind of provide these services, and this yours is significantly different from them for the variety of ways. But outside consultants are the best way if you don't have the internal resources. They can kind of get kind of expensive from time to time, depending on the relationship you have with them. So what I'll often do for my clients is I'll beat up the consultant a little bit on the front end and say, hey, it's a small deal. You mind helping me out? It's only $10 million. You help out here, and that you kind of pre-negotiate with them, and then they talk to the client. Yeah, I'll help you out. But a good one will give you a ton of confidence, because you're bringing it. You're walking in just, okay, well, you're obviously using this code for your business, so it must be working. But you don't have any idea if it can scale up as high as you need to. That's a big one. A lot of times the code works great at the current levels, but if they plug into your business and you're bringing in 12x users, is it going to crash the next day? You want to know those things, and so they can help with a lot of those different avenues.
Yeah, it's certainly. I'll just add on quickly that it's difficult, and at the end of the day, even after doing the best homework that you can, you're going to have to figure out what risk you're willing to assume in some cases. But by doing good homework around getting advice from experts on the outside, looking at it from a number of angles, not just the technology side of it, but you look at it from legal and claims, and are there patent trolls that are active in that space? Are they using open source software, or is it stuff that's proprietary code? There's a whole bunch of things that you get tangled up in understanding, and that are important, but they can, at the same time, not necessarily be an ironclad answer for you at the end of the day. And it ends up being one of the more significant conversations often when you end up talking about what are the indemnity provisions, and who's going to reimburse who for what kinds of risks should bad things happen down the road. So, whether that can then be addressed through certain forms of insurance, or through just the indemnity provisions, or holdbacks, or other things like that, it become part of the deal structuring. But it's certainly not something that you just throw up your hands and guess. You try to do the best homework that you can with the best informed judgment that you can get access to.
What would be the category that you'd be looking for an expert who knows how to do that? Is it an IT management company? What's the category that we would go look?
Oh, they literally are IT diligence firms.
Yeah. And sometimes we'll bring those in if we're engaged, ready for quality of earnings, and we identify that as a significant risk. We'll bring them in to kind of beef up our IT diligence portion of the quality of earnings if you're at that stage ready. But if you do it before quality of earnings, then we wouldn't include it.
And if you'd like, I can give you some names too. You don't have to guess and hope.
Yeah, Rick.
Yeah, we're a small company that's looking for growth through acquisition. So we have a disruptive technology that's very vertical, serves cities and consultants for the land development industry. And no debt, everything's developed, patented, everything, but our growth strategy seems to be the best to find that ideal company. Well, where would we get started?
Okay, so let me jump on that one. So question is, are you looking to make an acquisition, or are you looking to,
Through acquisition.
Yes. So actually, there are a couple of investment bankers in the room. I see one over here on this side. So why don't I talk to you offline on that, rather than, because that's not the domain expertise for these folks here. Unless you have an idea. Otherwise, I'll talk to Rick afterwards.
Yeah, I'll just be very brief because bankers are obviously, that's a great place because they have resources, they are trained and adept at reaching out and learning about these spaces and contacting people in a good, approachable way and all of that. But certainly as in trying to figure out who else is in the space, you know, depending on the capabilities you have within your organization, or if there are industry groups or associations or just other ways of having some inside trafficking of identification of who else is playing in that space, whether it's salespeople who come back and tell you who they're bidding against if you're in that kind of a business, or if it's a case of vendors that you know who can, maybe they shouldn't if for confidentiality reasons, but sometimes they'll let slip who else they're doing business with, and are they in the same kind of a business as you are. There's different ways of gathering that intelligence. There are consultants who do competitive intelligence work as well. They can be expensive. But contacting an investment banker is usually a very, very good and helpful and quick and relatively affordable way to do it.
And Rick, I can talk to you about that too. All right, so I want to get this question for sure in, and then again, if other folks have more questions, please raise your hand. We hear and read all the time that many, and maybe even most acquisitions fail. So in your view, what kind of defines success versus failure, and what are the common traits that you see with either the most or the least successful transactions?
Rick, when you say fail, do you mean fail to close or fail post-close?
Post-close.
Yeah, I'll jump in on this one because I kind of live this one. Every year I get to do a report back to the Finance Committee of my Board of Directors, looking backwards at the deals that we had them approve over the last few years and how they performed. And we use two general buckets of comparison. One is the obvious and most objective: how did the numbers work out? And how did they compare to what our original business plan was? On a number of different metrics. So it's not just a one-dimensional, but there's a lot of different ways of doing that. But at least it's objective. The other, and frankly equally important, is strategic assessment. We go into each deal with a thesis. Why do we want to do this? What do we think this will do for us? And we lay out what that is. And that's part of our pitch for why it's a good thing for us to spend resource on. And we come back to compare against that too, and whether the numbers were good or bad. If we thought that this was going to do X, Y, or Z for us to add capability, get into a new market space, gain some significant new customers, whatever those bits of the thesis were, did they happen, and have they been sustained over time? And in both of the cases, look backwards and figure out, well, what changed? Was it something external? Was it something internal? Was it controllable? Was it not controllable? Can we rationalize why things ended up differently than we thought they were going to, and what do we learn from that so that we can incorporate that into our thinking about the next one to do and the other ones down the road?
I'll say that I'll just be quick. Successful deals, it's a 1 to 2 year process before the LOI, and the LOI is very detailed, and everybody agrees to that on the front end, and cultures line up. Okay, that's probably from a successful standpoint. Failures, from my viewpoint, is state and local taxes. Over the last 5 years, my goodness, has that changed with states being aggressive. And that whole area of our diligence has increased significantly. I don't want to say I've killed a number of deals because of it, but we have killed a lot of deals because of state and local tax issues where there's nexus in other states. And that liability, when you start to add it up over the past 3 years, it gets to be a pretty material number that generally the buyer doesn't want to swallow, and the seller obviously doesn't want to pay for it. So.
Very good point. Thanks for
Also,
sharing.
Can I throw in one other one on the success or failure question, or the characteristics of where it works out better and where it doesn't? It seems like it should be pretty intuitive, but the things that are more controllable down the road are often things like controlling costs, and controlling the pace with which you make internal changes in the business. Whereas the things that are harder to control are those doggone customers. You know, if you have a cross-sell strategy, that's your primary driver, or you're trying to, you know, add something new to the mix, or get people to spend, you know, increase your wallet share with key customers, they don't always behave the way that you want them to, or expect that they will, or move at the same pace that you hope that they will. And so by their nature, when you look at opportunities, the revenue growth sides should probably have a higher risk factor attached to them in your thinking about how it's going to perform than the cost management and consolidation kinds of things that you're capable of doing.
Yeah, and maybe I'll just add, on the company side, one of the reasons for failure is when a company buys another company, it's common there's a mismatch in their go-to-market strategy. So whether they're bringing a product or a service to market, there's just not an alignment there. On the individual side, again, I'll go back to the rationale. If there's a vague strategic rationale for buying a business, oftentimes that can lead to failure too. And in the space that I'm in, although we're talking about acquisitions, I don't want this to seem doom and gloom on sellers, but sometimes there's not full transparency from the seller, which can also lead to high failure rates and fights and lawsuits and issues. I had a client that bought a service business a couple years ago and had found out after the closing that the seller didn't renew the international license, which was responsible for about 30% of the revenue. So a lawsuit ensued and the seller ended up forgiving the seller note. And so there's costs, there's expenses, trying to figure out kind of where things went awry. And so just full transparency on the seller, especially when there's an earn-out involved or a seller note, just leads to a more successful transaction.
Okay, got a handful of minutes here, so I got a couple of questions, but I want to get to them quick, so kind of lightning round, like 30 seconds answer. In the acquisition process, we have assessing, structuring, closing, integrating. If you were to look at two sides of the coin, where do people get the most bang for their buck or ROI on their efforts, both positively, and the flip side of that is where do they spend time that doesn't really matter that much?
Well, I would say assessing and integrating. I mean, the middle part is the doing, but that, you know, that like I think David mentioned earlier, that happens real. You know, that's a lot of function. It's a lot of value add if you do it right. But the toughest part is making sure the deal works in the beginning and then getting it right when you're done. I mean, to the question you asked before, what's, you know, when do deals fail? I think a lot of it's fail on the integration side. If you were wrong on the front end, you didn't assess that it was going to work really well, and you get to the integration and it doesn't, then you're in trouble.
Yeah. Well,
Go ahead, Dave.
Oh, go ahead.
I agree 100%. It's integration. I mean, that's really where, Dave, you mentioned earlier, that's the kickoff. That's really where the real legwork begins. And it's funny when you talk to people who have closed the transaction, they're like, oh, that was fun. It's like, well, you don't know what you're in for here now. The next year, you're just starting to run now. And that can be a long process.
Yeah, and I you know, the assessment is important. Are you spending your time on the right things to begin with? You have a strategy that is sensible, but the execution is where it really comes to pay off. And to be more specific about that is going back to those original objectives and making sure that you're spending your time and focusing your efforts in the integration on the things that are going to help you achieve your goal. You know, because you can get dragged into a lot of other things along the way. And there are you know, distractions. There are, you know, multiple functions and multiple facets in running a business, and each one of them can have their own issues in them. But trying to prioritize what are the things that are going to make the most difference to you in the end analysis, and staying true to that, which is hard to do. That's where the best part of the payoff comes from.
So we're getting to the end of the first half of the year. For a company that's looking to either make an acquisition or maybe even sell, what's something that they can kind of quickly and easily do, get up and running, and kind of start the process going?
It's kind of hard to think about the start of the process because it's so often a continuum, right? But if you're really starting from scratch, I mean, a lot of it does come back to, I'm going to say it again, it's the strategy. What is it you want to do? What is it you want to achieve? And getting clarity around those goals. It doesn't have to be lofty. It can be really, really simple. But having that clarity of purpose at the very beginning, and then figuring out how to put the right team together of your internal and external advisors to both bounce all that stuff off of, as well as to help figure out what are you going to do when you start to get down to the first steps are often, you know, the most important because you're actually making some progress toward it. But it's going to be a long road. As you know, Ryan, you were talking about, even when it's compressed time, there's just tons and tons of work to get done in each transaction. But you want to make sure you're spending your time on the right things and being well advised with a clear purpose, and knowing what the team is that's going to get you there is really, really important to being able to then execute quickly.
Yeah, I would simply say just preserve your liquidity, know what your risk appetite is so you can move forward with conviction.
And just, you know, if you're selling, know who you want to sell to, and have that net cash proceeds done. So talk to a wealth enhancement group or a financial planner to say, what do I really need to retire, to identify what you need to go to market to from an enterprise value perspective, and is that realistic? And if not, well, what do I need to do to get there?
Anything, Dean?
No, I agree with that. I mean, make a self-assessment, get your team sorted out, and make sure that you have the right resources so you don't get further down the road and you realize you missed some significant component.
Sure.
Yeah, and one thing to add, if you're selling, be able to prove you're not needed. Your business is worth more without you.
Very good point. Okay, to summarize and kind of wrap things up, closing thoughts, tie something up that's pithy and catchy and memorable, and makes a good quote in the magazine and a good little, you know, sound bite for the video.
Let's start on the
Tough question.
Let's start on the
All
right
together
side
now.
of the stage.
Oh, so much pressure. All right, I'll start. So as a seller, I would say know your financials, be able to explain any hiccups or trends, get the questions answered before they get asked. And as a buyer, be prepared. Have a team, get your team assembled, know your plan, and then be able to check your motions at the door. Don't fall in love with a company that doesn't financially make sense for you.
I've said it before, I'll say it again. It's the clarity of purpose. It's really important to make sure you know what it is you want to achieve, because then you can really focus in on executing to get there, and aligning both your resources and the targets to the right purpose. You know, if you don't do that, then it's going to be a lot of wasted effort. But I think the other thing, just as a reminder, you know, I said earlier about my friend who was the I catch 'em, you clean 'em guy. One of the things that we firmly believe and execute, doing it this way at Deluxe and everywhere else I've been, has really been to have the same people involved on the front end assessment as who are going to have to do the execution. So you're not handing off to people and have to do a knowledge transfer at the most critical time of right after closing, when you're supposed to hit the ground running and demonstrate to your new employees and your new company and your new customers and everybody else that you know what you're doing. But to be able to have good continuity and that strength and clarity of purpose that can show through right from day one.
And I guess dovetailing off what David said, I mean, you set expectations internally and externally. You know, with yourself, your team, understand what you're getting into. You know, it's going to be a lot of work. It's going to be a lot of stress. It's going to be a lot of everyone's time internally, and then externally, make sure that they understand what you're expecting to see, what your timeline is, so that everyone goes into it with the most amount of clarity that allows you to go through, deal with the bumps in the road. And if you're good about setting expectations internally, you won't get personally frustrated as easily. You won't get the sellers frustrated easily. Your team is frustrated as easily.
Mm-hmm. Yeah, there's going to be a lot of elbow grease, and you're going to be working hard, but really at the end of the day, it feels good to sign those documents and close, and then And then, well, if you are going to stick around for an employment agreement side of things, then enjoy that process. But just surround yourself with the right team of advisors that have went through the waters before to really help take some of that burden off of you, I think is really important.
Great. Well, thank you very much. Again, utilize the services of the folks up here. They have a lot of years of experience. I've worked with them all. I think you'd find yourself very satisfied having the opportunity to work with them. Thank you again to the Minneapolis Club, Upsize Magazine, and my group, Club E. Next event back here, June 6th. I'm going to be talking about regulated sports betting on June 6th. That sounds kind of fun. And then we have a little bit of time off until end of August, and we'll get back going with the Upsize Magazine partnership that you saw here today. So let's thank our panelists. Thank you very much.